All right, good afternoon, everybody. I see participants jumping on board here, so as they do, we will get started a little bit. My name is Jon Meyer. I am the president of the wealth management side of BGM. Today, I'm joined by Russell Brownback. Russ is a managing director at BlackRock. He is also the head of global macro positioning within the global fixed income. What if you work with us at all, you may know BlackRock a little bit for their strategic bond fund and strategic income opportunities fund. Russ is the co-lead manager on those funds. So you may have some of this stuff in your portfolio even. So I welcome you. And with that, we're going to run this today as a Q&A. I'm going to basically ask Russ a bunch of questions for the first probably 30, 40 minutes. And then if you want to ask questions yourself, you are free to jump in with the Q&A box. And so from the Q&A side, you are able to ask questions and I'll watch that box. I am getting a question that popped up that says they can't hear anything. Stacy, I don't know if it's on their end or if it's on our end. Can you check on that?
Yeah, I can hear you guys all right.
Okay, so it might
Everything
be on
sounds good
their
to me.
end.
Yeah.
Could you answer that for me? So with that, welcome, Russ. I hope you're ready for a bit of a back and forth. Um,
Yeah, bring it on. I'm excited.
bring it on. Bring it on. Here we go. All right.
Exciting times in markets. Yeah.
Yeah. Well, let me get started a little bit with some basic questions I just have. We all think of risk as losing, but technically there can also be risk to the upside. So where do you see the most downside risks in the economy in the next 12 months? And conversely, where we might be surprised to the upside?
Yeah. So, listen, there's a really unprecedented set of influences today driving things at a time when some of the more reliable data sources have become a lot less so. Think about all the soft data, all the survey data, which has really, quite frankly, just been wrong over recent years. And now, whether it's through, reduction in staffing and the like, or a shutdown of the government for that matter, some of the, lots of the traditional data sources have become less reliable. So, that only adds to, the excitement or the uncertainty. Just to get at kind of the tail end of the question, what's the biggest risk today? Because quite frankly, John, we see it as a pretty bullish set of directions, influences going today. I have to say it's the risk of an unexpected shock. And I know you might think that sounds like a cop out at the beginning, but look, I've been doing this 37 years and it's the LTCMs, the 9/11s, and the pandemics, that come along that you don't see. And the reason I highlight that today is, when you think about the policy response to the pandemic, you had a tremendous amount of fiscal room to respond. The balance sheet on the part of the Fed was smaller as a starting point. You didn't have quite as much interest rate room, but you had a more kind of a bigger chamber of ammunition, to fight a shock like that. So the biggest risk is another exogenous shock that comes along at a time when we have less sort of headroom to respond to it. I guess I've learned over the years that the wrong thing to do in portfolios is try to hedge against unknown unknowns because you just end up losing money. And the better thing to do is always manage overall portfolio liquidity so that if something happens, you can be front-footed and have the liquidity to step in and take advantage. You make your money after the shock, not before the shock. Listen, the bullish story that we have, has its underpinnings in I would say, two or three really broad things. One is the structural underpinnings to the U.S. economy today. It's a services-oriented economy. Services, 80% of the economy just doesn't realize cyclicality any longer. So absent a shock, the U.S. economy doesn't organically evolve or devolve into a recession like it used to. You need a shock or a policy mistake or something. Second is, what I think is probably the most undertold story today, even though you hear about it in the equity markets, is this productivity boom that's unfolding today is like nothing we've ever seen before. I think it's top of the first inning. It comes with structural investment in CapEx, in AI, in power to compute, to run all the computing that's needed. which is another tailwind to growth. And then you add on top, the Fed has resumed cutting interest rates. You've got a fiscal policy that's now a tailwind to the economy, and financial sector deregulation. So we think those things are the transcendent driving influences. Last thing I'll say, John, is look, there are pockets of weakness. The housing market is struggling from the high rate paradigm. Low wealth, low income cohort households are struggling. Small businesses with floating rate debt are suffering. And so one of the reasons we think the Fed is going to continue to deliver rate cuts is that you just have these unequal outcomes accruing in the economy today. And we think that because of the productivity, the Fed can cut to address those weak spots that are rate sensitive, even though the other parts of the economy are humming along pretty well.
So let me unpack that a little bit. One thing you did not mention in that is the magic word tariff. Is that policy risk behind us?
Yeah. Yep. Okay. So again, it's never as easy as, yes or no. So I think the worst of the tariff risk is behind us. The worst of it was the uncertainty about how the policy was going to be implemented and the tails. So you could take you back to April 8th and Liberation Day. Everybody was shocked. We've since learned that, the style of this particular policy body, this administration, is to put all the chips on the table at the beginning and then pull a few back, when you need to. And so it's kind of this maximalist entree followed by a more pragmatic evolution. And so I think to the extent that the biggest risk here was the uncertainty, which dents sort of animal spirits and velocity in the economy, that's over. Now we know we're headed to kind of a mid-teens effective tariff rate in the economy. We've also learned over the last 5 months that it isn't all borne by consumers. A good bit of it's borne by exporters, and then a big chunk of it, there's whatever, a dozen nodes of value add between the time the good comes to port and the time at which it ends up on a store shelf. And there's dozens of economic actors to take a bite of that tariff apple, so to speak. And then, John, think about it. Okay, $350 billion of annual tariff revenue. People will say, gosh, that's a savings of the private sector going to the government. But not if the fiscal 26 deficit's as big or bigger as fiscal 25. So all of that revenue that's going to the government is coming right back to the private sector in other forms, in the form of tax cuts, in the form of investments, incentives, and the like. So the actual tariffs themselves, we think, are something we look through. The uncertainty was the worst part. The worst of that's behind us.
To your point, though, we have all this new money coming in, and yet we shut the government down today. Kind of ironic. Is the government and fiscal deficits an issue we really need to worry about? I think that's one question I always have.
Yes. And I'll tie it to the very first answer I gave about what the tail risks are to the economy. And it's that we start from a point where we're already, leaning way over our skis in terms of deficit spending. Now, I think Chair Powell has framed this discussion really, really well over the last couple of years. The U.S. Deficit trajectory is unsustainable, but we are nowhere near a solvency tipping point. And when you start to marry, the reality that we live in the world, and so yeah, the government shut down today. That's really procedural. It's political at the margin, but we live in a world where there's too much money and not enough yielding assets. And I think that's what the narrative in markets. And you hear this. You came back from Labor Day, and again, it's like, oh gosh, the UK bond market's having a problem. Bond vigilantes are back. Bonds are becoming unanchored. And then you look and you'll say, okay, the U.S. aggregate index annualizing to an 8.5% annual, return. The global ag to an 11% annual return. So there's no real outrage. There's outrage, maybe some hedge funds with megaphones, maybe on CNBC, on Bloomberg, or what have you. But so there's $25 trillion of cash on the balance sheet of the private sector. That's more than all marketable treasury debt of every single maturity. There's $225 trillion of private sector net worth. All of it, at the end of the day, is the purview of the taxing authority of the federal government. So I'm not saying there's going to be a wealth tax, but the idea that there could be a wealth tax just shows you how kind of insane the proposition is that somehow we're near a point of insolvency at the end of the day. And so, And then you think about the way this administration talks about sustainability of deficits. They talk about it deficits to GDP. And here's a statistic that no one ever talks about. We've had $9.5 trillion of fiscal deficit cumulatively over the last 4 fiscal years. Debt to GDP is flat because we've outgrown it between inflation and real growth. And so, when you talk about, listening to Besant talk about, the sustainability, it's about the denominator. It's how you get growth up, not how you get spending down. So I think that's the path going forward, with the tail risk being somehow we need another $5 trillion response to some shock.
Well, and to your point, we've grown our way out of it, but are there other geopolitical risks we're not thinking about, like China, reshoring, energy supply issues, all these other things that seem to pop up in the media?
Yep. So again, I'm going to put that into the unknown unknowns. I think you could say if we started the year, if there were 3 potential hotspots, Russia, the Middle East, and China, Taiwan, the Middle East has come off the boil, so it's the other 2. Those are known unknowns. The unknown unknowns I would characterize this way. So definitionally, we don't know what they are. I guess if there's one thing geopolitically that keeps me awake at night, again, get back to and it's not a political statement, it's a management style. This administration tends to think that an opacity to process is a strategic advantage. So you think about all of those years during the Cold War, even during some very acute days, there were always back channel communications that would take place. There were, in case something went off the rails, there were protocols in place to de-escalate. And I think those are fewer today. And so, the risk is, there's a mistake made. There's all this inflammatory chatter today about, what if a Russian plane flies into NATO airspace? What do we do? If there's an accident, I just worry that some of those off ramps are lacking today. But again, that goes into the unknown unknowns. And those are things in markets that you're meant to react to, not try to sort of hedge against ahead of time.
Sure. You mentioned interest rates, and I'm curious, the Fed right now keeps saying they're heading in a direction, and they're very slow and steady path. That's always what they tell you. But under what conditions would you expect that policy to pivot to be a more aggressive stance? And how does that impact the economy and markets?
Yeah. So we were heartened on the one hand that they pivoted at the most recent meeting and acknowledged a better balance between kind of their price stability and labor market mandates. But we were disheartened that they didn't go further with acknowledging what we've seen in the data, over the past 4 or 5 months. And that is, okay, first of all, we live in a secular disinflationary world. So we had too little inflation, prior to the pandemic. The big problem was the Fed was fighting for inflation from beneath. Since kind of the beginning of 2023, inflation has disinflated. We were on our way back to 2 before we got to this year, and tariffs temporarily slowed that down. And so they've wrung those influence. When you put $5 trillion into the bank accounts of the private sector like they did in 2020 and 2021, which, by the way, was the right thing to do, at the exact same time the supply chain is shutting down, you have too much money chasing too few goods. That's inflation. That needed to be leaned against. It was. But you've had inflation come down almost in a straight line until the middle of this year, where because of tariffs, that progress has stopped. Now, tariffs aren't inflation. Tariffs are a tax. They move the price of a good up one time. And to me, inflation is recurring. And so it's, higher goods prices, people pay the higher prices and then say, gosh, I need more wages. They go back and ask for more wages. Those wishes are granted. And then the vendor goes back and says, I have to raise the price again. And that becomes and that's what the Fed needs to worry about. But that's not what's happening here. We live in this disinflationary environment. Think about billions of economic actors today with perfect information about the economic value of everything in real time because of ubiquitous connectivity. Think about when you check out of your Amazon cart and you look at the banner that appears across the top of the page. It tells you what went up and down in price since the last time you bought it. Nobody should go into a Best Buy today and buy a smart TV or something without having gone online first and finding out what the best deal is, because what the lowest price is anywhere. That didn't exist when the last time we had inflation. So That is a headwind to inflation. So too is, think about, I'm going to give you a couple of examples in corporate America. So there was an IKEA executive on a Bloomberg program early last week, I think it was. And he used the phrase, "We are investing in price," in response to a question about tariffs. And what he means is they are taking the uncertainty around tariffs, taking their strength, and being the low price leader to get market share. Walmart, April 12th, annual investor days, 4 days after Liberation Day. Is there a company more in the crosshairs of the tariff situation than Walmart? I would argue not. They re-underwrote that day their commitment to spend $25 billion a year on robotics and AI to take share. So again, that's what American companies are doing today. They're utilizing whatever uncertainties come. If they have extra margin, they're investing it in taking share by keeping prices down. So you put all those things together, it's really hard to have lasting inflation today. So look what's happened to the data over the past 5 months, and actually ran these numbers this morning. We have revised away 400,000 jobs since Liberation Day. We've also taken our internal growth tracking for 2025 growth from 0 to 1.8%. So growth's accelerating, jobs are decelerating. That's a productivity boom. So you're doing more with less. And so, to me, that's a world where the Fed can and should be moving the funds rate down. When you got millions of households suffering from high floating rate debt, and you've got this productivity dynamic, you've got these disinflationary influences. And I think over the next quarter or two, the data is going to give the Fed all the cover they need to bring the funds rate down.
And to that point, as they bring it down, typically what happens in the markets?
So, and this is something that we've got these great portfolio optimizers that we're getting better and better, and utilizing more and more all the time, again, thanks to the help of AI. I think we actually had a really great internal debate about this today. We traditionally have thought about a 4-quadrant framework: inflationary boom or inflationary bust. And in those environments, you can't count on falling rates as a ballast to your portfolio if for some reason your risk is not doing well, or stocks are going down, or credit spreads are widening. Or the other two are disinflationary boom or deflationary bust. And in those instances, falling rates, you can count on those to be a ballast to your risky asset portfolio. So that brings us to the debate we're having today. It was a very clear regime from, say, 1980 to 2020. Rates were coming down. It was a disinflationary boom. During the pandemic and in its aftermath, during the Fed tightening cycle, it was an inflationary boom. So the economy was doing fine, but the Fed could do nothing but continue to raise rates. And there, you couldn't count on falling rates to help your portfolio. The big debate today is, have we pivoted back to a disinflationary boom? And we have different views on the team. I think the regime I just laid out, in terms of a growing evidence in productivity accelerating from 2 to 3%. Think about what productivity at 2% means. It means you can grow the economy above its potential real rate. So potential is 1.8, means you can grow it at 2 without adding 1 minute to the work week. And so if that is indeed the regime that we're in, falling rates is really, really, good for kind of all risky assets in general. And I think that's the regime that we are firmly in now.
I'm going to come back to that. I want to touch upon something you said earlier when you touched upon labor markets. Are we in a new structural shift in labor markets? And one of my thoughts here is does AI change the game a bit, and white collar workers are going to lose their jobs faster than we even think?
Yeah, I mean, this is probably the most hot button issue I get whenever I'm talking with clients. So there's kind of 3 things that have sort of led to a lower velocity labor market this year. First one is the supply story. It's related to immigration, which is actually kind of virtuous. If you think about, we had a surge in immigration at the exact moment when the labor market was tighter than it had ever been. So you got a lot of job growth, at a time when job openings were way above where they had been historically. Now, job openings have fallen. You still have some structural pockets of tightness in labor markets, but immigration has essentially gone to zero. And so you're not adding to the labor force at the exact same time that people aren't looking to hire. So that's been virtuous. We don't think that's going to change anytime soon. Second is what we talked about before in terms of the rollout of policy earlier this year that created uncertainty, and that sort of led to a temporary cessation in hiring and CapEx. We think that's a tailwind now because those uncertainties have mitigated. Okay, let's get to the question that you asked, which is what do we do with AI? What do we do with productivity? And again, I think this is early innings. So, we're only in, I think it's maybe a quarter, maybe 2 quarters into the point at which AI has gone from being about training large language models to benefiting from the inferencing of those models. And the example I'll use is it takes billions of dollars to train a car to drive autonomously, and you get no return out of it. The minute the car can actually drive itself, and you can have robo-taxis or driverless, trucks carrying freight, the margins are massive. It just drops right to the bottom line. And we are in that moment where inferencing is really beginning to move the needle in the private sector. So right now, it's largely the tech sector. You think about code that can write itself or software that can design itself. And so what we've seen over the last 2 years, virtually flat headcount in the tech sector, even though those companies are growing like weeds. I think we're in a moment where that inferencing is moving to the physical economy. Inferencing is moving out of the cloud or about to and into the edge, meaning your AI power will be in your smartphone, in your wearables, in your vehicle and the like. So generative AI will be part of the physical economy, humanoid robots, autonomous weapons, in medical research, the use cases really go on and on. Will that lead to broad scale labor obsolescence? I think there was probably worry about that when we invented the steam engine and the automobile and the airplane and electricity. And the evidence is in US history, that the pie just gets bigger rather than, it's a fixed pie. And so there are winners and losers. And so there's one great statistic that I read somewhere over the last month. So in 2007, there were 150,000 video rental clerks in the United States. Today, I don't think it's zero, but it's not much above zero. Today, there are 400,000 people employed as YouTube content creators. So influencers, they don't even work for Google or Alphabet or YouTube. They're independent contractors that make full-time gainful employment by creating content on YouTube. Those jobs didn't exist 20 years ago. So the history of American innovation is one where the pie gets big enough to absorb labor. And I think betting against American innovation is the worst trade anybody's ever made. And so, look, it's a complicated labor market picture today. But we do not see job destruction today. You simply see a cessation of hiring, some of which will come back, some of which is more structural.
So I'm going to pivot just a little bit because you have some expertise in the bond side and market. So I want to shift a little bit. If you talk to a lot of bond people, they'll say that they know stuff that people in stocks don't know. So what are the bond markets telling you that the stock market might be missing right now?
Yeah, I love the question because I just answered with a lot of verbose answers to your questions. This is a one-word answer: productivity. And so, traditionally, you'd say, gosh, boy, the bond market's reacting to, labor data that continues to, trend downward. But what's the stock market doing? It's reacting to the growth data that's going up. And like there's a dissonance there. And I think if you view all of that through the lens of productivity, which means that you can do more with less in the moment, I think that explains, why bonds have been rallying and stocks continue to rally. Sorry, that was more than a one-word answer, but couldn't help
No,
myself.
but it's a good segue. To that point, are you more bullish on bonds or stocks over the next year or two? And is it a story of bonds being good or stocks being bad?
Okay. Again, great question. I love the way you frame them. So we're bullish on the 60/40 portfolio today, but it's not your grandfather's 60/40 portfolio. So, for several decades, leading into the pandemic, you could own the S&P 500 and the aggregate index, and life was pretty good. And today, you still want a roughly 60-40 portfolio, but your 40 is fixed income that's comprised of a regime that's about harvesting income. And so we don't think there's a big, huge directional bet in rates. I talked about the Fed cutting, but I think that's priced. So the Fed's predictions of where they'll be at the end of next year are in the mid threes, but the market's saying they're going to be in the high twos with the policy rate. So that's already priced. There's no real duration trade to bet on. And the back end of the yield curve gravitates to nominal growth. I think it's done a pretty good job. So in the old days, again, it was this big directional trade for rates. We don't unless there's a shock. If there's a shock, rates would drop a bunch. But we don't see that. So what is the opportunity? It's the ability to be in the right part of the yield curve and then add corporate credit and securitized assets on top of that and get yields that are 3.5 or 4% above the rate of inflation. And so you've scant in my career have been able to say that bonds are sexy because they really aren't traditionally. They are today. When you can get in a bond portfolio a real yield where you can double your purchasing power in less than a generation, I would say the holy grail in the previous generation was if you can maintain your purchasing power with a 100% portfolio of fixed income, that's pretty good. But if you can double your purchasing power, so anyway, we think clipping coupon in a diversified way, you can't get it on the risk-free curve. You do need, and what we've been endeavoring to do is build these, multi-sector investment grade rated portfolios that yield 6 or 6.5% nominally or 3.5, 4% real. So that's your 40, and that's a really exciting opportunity. The 60, instead of it being the S&P 500, you got to find, and Rick Reeder, our CIO, likes to call them the fast rivers of cash flow. And so this is a uniquely American moment in terms of what companies are doing today. So these are great stats. So the top 25 companies in the S&P 500 have a greater than 50% average return on equity, which is just unbelievable. It means you can grow your book value 8 times over 5 years. It's like nothing we've ever seen before. The top 100 companies, lest you think this is a Mag 7 story or too concentrated, the top 7 have an average return on equity of 32%. That's more than double the Euro Stock 600's top 100 companies. So these are unbelievable. At a 32% ROE, you double your book value in 2.5 years. Wow. That to me, that's pretty wild. And my guess is your next evolution of this question would be, okay, what about the Russell 2000? What about small caps? Is this about just growth stocks? Fast rivers of cash flow can also ultimately mean companies that are in the physical economy that begin to benefit from generative AI, which is I think top of first inning. I think you're starting to sense some of that in markets. I think instead of where in the rear view mirror, we've thought of the equity market as growth or value or big cap or small cap. I think there's 2 kinds of companies in the world going forward. Those that are front-footed on generative AI and those that aren't. And those that are going to be disruptors, and those that aren't are going to be disrupted. So again, your 60 is about picking the fast rivers of cash flow, finding those companies that are at the leading edge of this movement and getting those crazy high compounded returns along with that great income opportunity and fixed income.
Okay, so let's lean into that a second. Because over the last, let's say 20 years, publicly traded stocks continue to decline. Fewer companies go IPO, a lot more private equity just buying stuff out. So as those continue to shrink, one of the discussions we've had is adding more privately traded markets, whether it be private equity, private credit, you name it. Let's lean into that a little bit. Over the next, let's say 10 years, how do you think private markets come into play in a portfolio that's different? To your point, AI in some of these private markets might be a stronger theme, potentially. So just talk a bit about how we add private markets to what used to be just a publicly traded portfolio.
Yep, I love it. And by the way, the statistic you threw out is relevant to the last question. One of the reasons stocks keep rising and value and we can keep going in spite of valuations being high there's a tailwind to the E in PE from the fact that there's so much stock buyback going on today. So companies are, the equity market's decapitalizing. So companies are choosing to go private and others are choosing to just buy back their own stock. So the public equity market is getting smaller, not bigger, which is an underappreciated fact. So I'm glad you pointed that out. When I think about, and I'm a fixed income guy, so I'm going to lean more heavily on the private credit answer to this, but it's relevant to both. We don't really delineate, nor have we ever, between public and private markets per se. We're going to look at, and again, I'm speaking about credit. First, you're going to look at the credit risk. Is the risk premium wide enough or high enough to justify the implied credit risk of the portfolio? For private markets, you would add on, or for any asset really, you'd add on, okay, is the security more or less liquid than the average security? And there you need a liquidity premium on top of it. So for private credit today, you want to say, am I rewarded enough for the risk? And am I being paid enough extra for the illiquidity of the asset? And if it is, you don't really care if it's public or private. You say, gosh, that clears the hurdle. I'm going to put that in the portfolio. Now, my caveat is, when I'm thinking about our multi-sector portfolios that I described before, we have to manage not just the liquidity of the particular line item or asset, but the liquidity of the overall portfolio. And so, we're going to lean into bespoke private credit today because there's great opportunities out there. But we're always going to manage those portfolios to have sufficient liquidity. And that gets back to the very first thing we talked about. You want to be front-footed if there's a shock that comes along. Always, I think it's underappreciated the degree to which any portfolio should have sufficient liquidity. So, again, from the perspective of private versus public, are you being rewarded enough for the asset? I'll also say this. People say, gosh, isn't it getting crowded? There's so much money pouring into the private markets today. I think the time to be nervous about misallocation of capital was pre-pandemic, when you had financial repression, when you had interest rates artificially low, cap rates artificially low, you had marginal private equity companies. The whole game was, let me lever up, pay a little bit down, sell at a higher valuation, lever it back up. You can't do that anymore, and so some of those companies that probably didn't deserve to be refinanced over and over again aren't having success doing so today. Those sponsors are not getting their money out. Some of those companies just aren't making it. What does get financed today in public or private markets, it's done at the right price. So there's a much more capitalistic environment today than we had before. We find that really exciting. Last point I'll make is credit spreads are tight everywhere. There's not a big beta trade to be had in credit markets in general, except down the stack where there's real dispersion. And so when you get into more levered situations, which oftentimes some of these private credits are, the markets are very discerning. So again, to my point about things, you want to avoid the losers, you want to pick your winners, but you can rest assured that, that the markets are, I am anyway, the markets are getting to the right price on these things. And so you can get, 10, 11, 12% on some of these assets. Are they riskier than, investment grade assets? Yes. But we think in most cases we're being rewarded both from the liquidity perspective and the credit risk perspective. So we're really excited about the opportunity of privates.
So you touched on something that we've been talking about internally, which is stocks are stocks, bonds are bonds. We don't care if it's public or private. But to your point about liquidity, lean into private credit for a second with me. It goes back to the old idea of you name the price, I get the terms. If I name the price, you get the terms. When you talk about private credit, what are some of the terms that you see that are different than in a public market? Like if you get these couple of things, you've got better default rates, whatever it might be.
I love the question. And I can't go too far down in the weeds on that. And thankfully we have, hundreds of people that do that work and all that negotiation for us. I will say that we do see pockets of froth. So there are certain tranches of commingled risk and conduit structures and the like, where say you have, I don't know whether it's an insurance company and there's certain small deals they can't play in. They need bigger scale, bigger size of deals. And so the universe is definitionally smaller for some of those smaller deals, and therefore the terms tend to be more favorable, is my point. And so, again, there's massive alpha as far as I'm concerned to navigate what you just described, because there are pockets of where there's more leverage or less leverage on one side or the other, and that can make the terms of the loan more or less favorable. And there you really need experts to look at every single deal, at every single set of covenants, at every single, negotiation, and decide where you want to be. So listen, I think privates belong in every portfolio. I think you have to have experts help you with it.
Yep. No, I agree. I want to step back for a second. This isn't necessarily a private versus public thing, but it is about markets. International investments have been extremely hot this year. For people watching, if you've got international, you might be double what you are in US markets. Do you think that trend is going to continue as we move forward over the next year or two? And what could disrupt it? Because right now there's a lot of argument that, oh, that's partially just a dollar trade, but there's other things going on. So could you talk to that extent a little bit?
Yep. This is one of my favorite topics. I'm pretty convicted in my view here. So again, there's, this year, this is the year of hyperbole. There's a whole lot of narratives that just get blown way out of proportion by the media or by the fast money community or whatever it is. So there's very definitely something different today than we had a year ago or 5 years ago or 10 years ago. So, if you look back 40 years, the dollar's up 30. If you look back 30 years, the dollar's up 40%. 20 years, it's up 15%. 5 years, it's up 5%. In other words, it's a long-term trend up, just like it's been a long upward trend in equities. About 10 years ago, foreign governments stopped buying US assets at the margin, but foreign retail investors stepped in and more than filled the void. So we've experienced inflows all the way up. You had a secular bull market in the dollar. So it became, pretty much convention to buy US assets and hold the FX risk. Now you've got an administration that has signaled it would like a lower dollar. And so the hyperbole is, oh my gosh, it's the end of this, the dollar is the world's reserve currency. US exceptionalism's over. Okay, let's unpack both those. One, the dollar is the world's reserve currency will be the last fiat currency that's the world's reserve currency that we have in my lifetime. I'm 60 years old. So for the foreseeable future, it's too embedded in the machine of the global financial and real economy. It's like, and my analogy is, it's like trying to get a country to change its system of weights and measures, from metric to imperial or vice versa. Like you'd have to change every bathroom scale, every road sign, every speedometer in your car. Completely and wholly impractical. No reason to do it. The dollar is so embedded in trade finance, in trade invoicing, in the way reserves are managed in FX transactions. So I don't think that's going anywhere. US exceptionalism is about returns. It's not about politics. It's about returns. And that the private sector has transcended Washington, D.C. for 25 years. Somehow, in spite of all of the ebb and flow of politics in Washington, the economy is 3 times bigger than it was when we entered this century. And we're on the brink of a productivity wave. And along the way, we solved for energy independence. We invented the smartphone. We led the world in vaccine discovery. And now we're on the leading edge of AI. So US exceptionalism is about that. It's about entrepreneurship. It's about returns. It's about a greater ubiquity of opportunities in fixed income markets, more depth, more liquidity, more opportunity in credit markets. And it's about better shareholder returns. So here's a great stat, John. In 2024, the S&P 500 returned about $1.5 trillion to shareholders in the form of stock buybacks and dividends. The entire market cap of the German DAX index is 1.6 trillion. So the S&P gave almost that amount back last year. You can't replicate the kinds of returns you get in the US. And so there are absolutely global opportunities in stocks, but broad allocation away from US assets, I don't see as a regime that we're in. I just think the opportunities are too good in the US. What I will say is that if the dollar is going to be engineered lower for political reasons, then if you're a foreign investor, you might decide on the one hand, I'm going to keep my US assets. I'm just going to hedge the foreign exchange exposure. And in fact, that's exactly what's happening this year. So I had the team run this yesterday. Through the end of July, which is the latest data we have, foreign flows, which are almost exclusively private sector flows, foreign flows into US assets are running 40% higher than they were last year. But the dollar's a little bit weaker on a year-over-year basis. And that's probably because when that money comes in, those foreigners are saying, I want the risk, but I don't want the FX risk. And they're just hedging it out. So that's how I'd answer that. Definitely opportunities globally, but not to be underweight US assets. I just don't see that as the right maneuver.
Okay, and to that point then, let's talk about US assets. Small caps have underperformed in comparison to what's going on. What's going to change that end of the spectrum, because they typically like risk?
So I'm going to go back to my one-word answer. It's productivity, it's AI, and it's again. So we were at this great offsite yesterday. We had Tom Donilon, who's our geopolitical expert. He was President Obama's national security advisor, and he talked about. I didn't plan on using this, but I gotta say it. It's in my notes. He talked about the failure of imagination, and he was using some national security examples. But I think we all risk, a failure of imagination today to say, gosh, growth stocks haven't worked small caps haven't worked for a really long time. Value hasn't worked for a really long time. I think we have to tear up the playbook. It's not about value or large cap versus small cap. It's about who's taking advantage of revolutionary tools to be more efficient, to grow their profit margins, to take market share, to be market leaders. And again, I'm not an equity expert, but I have equities in my PA, and I get to sit in on all the meetings we have with our equity experts across the team. Gosh, I think you really have to do bottoms up analysis, understand what's happening, what's available to these companies to utilize, and how quickly and aggressively they're coming in and utilizing these new technologies. And you want to be long the ones that are front-footed and underweight the ones that aren't.
So let's step back a second. You mentioned the dollar. I just have a follow-up question. The Genius Act that was passed this year, a little bit in my mind at least, is saying that stable coins should be here in the US. And in essence, that makes the US dollar that much more important. I don't know if you agree or disagree with that, but any comments on that part? And I'll give you a softball. Throw in anything you want to say about crypto before we wrap up questions here, because I know you guys have an opinion on crypto.
Okay, well, we have another 2 hours, right? No, I'm
Right.
just kidding. Okay, so I love both those questions. Okay, the stable coin question as to whether it's relevant, in terms of the dollar and flows to the dollar. So stable coins, here's how I think about stable coins. So if you're going to go to a casino in Las Vegas, you can't play blackjack with your $20 bill. You have to go and buy the chips from the cashier, and then you get to go use those chips. You can't play in DeFi, decentralized finance. You can't buy tokenized stocks or cryptocurrency or tokenized ETFs or tokenized real estate or wherever that's going to go, unless you have the money that works in that ecosystem, and that's stable coins. So those are the poker chips, as it were, for the world of DeFi, which is very nascent. And I think it's growing. And so I think there's a real viability there. The degree to which the Genius Act puts rules around that, regulates that process, that's very heartening to me. That just adds efficacy, to that mousetrap. So, I think that's here to stay. The only reason that it would be, a magnet for the dollar or helping for dollar flows, is a greater ubiquity of US dollar denominated stable coins. So, you could have 5 European banks come out and create euro-denominated stablecoins, or anyone in Asia. There's a credibility issue to every coin. Listen, I think if I'm Jamie Dimon, or any one of the large big banks, and I have the greatest credibility of any financial institution in the world, I'm going to have JP Morgan coin. I think there's a first mover advantage here. So it's only a benefit to the US dollar to the extent that US actors are first movers in creating these things. And so far, that's the case. Crypto more broadly. So I delineate DeFi, stablecoins, crypto, put that over here. Bitcoin is a different asset class. Bitcoin and gold are store of value assets. They're money. They're anti-sovereign currencies. And I have an index I created. I created it actually before Bitcoin came into play. But I like to look at gold. It was gold before, now it's gold and Bitcoin. I take the entire global market cap of all proven gold, both above and below ground, and now the market cap of Bitcoin. I add it up and I compare that to the amount of global fiat liquidity or base money. And I won't bore you with it's basically my proxy for how much money there is floating around that's faith-based by the major governments of the world. So in that ratio peaked in the late 70s. That was only gold at the time at about 75%. We had a lot of upheaval then globally, a lot of dislocation. People wanted that anti-sovereign asset. That relationship troughed in 2000, and that's the only year the US had a federal budget surplus in my lifetime. It has now made a new peak. And we live in a world where generations of norms are being shattered on geopolitics, on monetary policy, on fiscal policy. And so you can see the global demand for these store of value assets that are anti-sovereign or not faith-based money. So that's at an all-time high. And I don't really see that changing. And you know, listen, I think, heaven forbid, there is another shock where we have to monetize another $15 trillion globally, print $15 trillion of fiat money. You could see that ratio go a whole lot higher. So I think everybody should have some allocation to store of value assets. I don't know if it's 2 or 3 or 4% or something. I have about 4% of my nest egg in a combination of gold and Bitcoin. You know, that's a tail hedge, like a world-ending hedge, you know, and a debasement of my money hedge over time. So that's how I'd characterize that.
Okay, I've got a couple more questions, but I'm going to jump to the questions other people are asking first because I want to make sure they get some time here. Can you, let's see. So here's one. Can political instability coexist with economic growth? And under what conditions does this paradox occur?
That's a great question. And I think the answer is yes. And I think the answer is, to what degree is the geopolitical instability or the political instability? And sorry, was the question geopolitical or political?
Political instability.
Okay, so I'm going to answer it both ways. Okay, political instability, I'm going to take as a question about domestic political instability. And I will say, thank God for the founding fathers, and thank God for the guardrails built into the Constitution, and thank goodness for the financial markets being the closest to the money guardrail around political instability. I think at the end of the day, you know, Congress, policymakers answer to the voters, and the voters have some tolerance for political instability, but when it hits their wallet, they have no tolerance. And so the immediate guardrail is exactly what you saw in the second week of April, where we had these open-ended tariffs and big tail risk, and the equity market went down 20%. And it forced a pivot in policy. It forced the administration to take some of those chips off the table. So at the end of the day, the private sector and its innovation and entrepreneurship, it transcends dysfunction in Washington. And I believe in both the institutional guardrails and the capitalistic guardrails around it. Geopolitically, I think it matters, you know, as to whether the geopolitical event is existential to the economic actor. So early in my career, every time there was a flare-up of geopolitics in the Middle East, you know, oil spiked, risk markets in the US went down. We were energy dependent then. Today, we're energy independent. So people are like, I don't understand why when there's upheaval in the Middle East, it doesn't impact US markets anymore. Well, because we have our, you know, if prices go up, we just turn our spigots on. It's not existential to you know, economic actors in the US. So it depends on, you know, whether market participants and real economy participants think whatever the upheaval is really hits their wallet or whether it hits someone else's wallet.
So a question came in about the purchase of gold bullion versus something like GLD. It's that bigger question of, does it matter what the vehicle is that you purchase this stuff in? Because when you monetize something, does that change the inverse relationship that sometimes you're after?
It depends on how big your tin foil hat is. No, I'm kidding. But listen, I have all the sympathy in the world for fears about tail risks and the like. Some of the commercials I hear on satellite radio about how I can buy 30 years worth of food that's delicious and it can live in my bunker are a little bit extreme. But I understand the idea of actually holding on to some of this stuff that's not plugged into blockchain and it's not in a bank somewhere that's regulated and can't be confiscated. And I get that. I absolutely get that. And I've been a holder of physical gold, and I still am, but I'm not going to tell you where it's buried. But again, that's not terribly liquid, and it costs you $50 or $60 an ounce in trading costs to get in and get out of gold, which is highway robbery. I can't believe that's still the case. And so it depends on, again, how worried you are about the system collapsing and there really being an end of world outcome. And by the way, if there is an end of world outcome, you should have gold and silver because you can't buy a cheeseburger with a ounce of gold. You'd need an ounce of silver to buy lunch with.
Right.
And I say that in jest, but again, think about liquidity as you're doing that. In general, unless somehow the rails are coming off with democracy in America, GLD is a pretty good mousetrap, and so is IBIT for Bitcoin.
Yep. I'm sorry. I should have given you IBIT. So,
Which by the way, I'm worried about, and I don't know. To me, just I'm speaking right off the cuff. I don't really want a crypto wallet. I like an ETF that's owned in a regulated entity run by a regulated company. I happen to work for the company, but there's plenty of options out there. Traded on an exchange. Let them deal with holding the Bitcoin. I think for me and it's liquid. I think that's a good expression.
yep. So unless more questions come in, I have one or two to wrap up and get you on your way. What am I not asking? I always like to ask that question at the end. Like, what am I not asking that you can share that give us insight into how you think about the economy, markets, how you manage money, however you want to think about this?
So we covered the entire world today. I guess what I'd say is, I'm just going to come back and come back to this idea about the failure of imagination. And the market feels very full. It feels too good to be true that rates can be rallying and that the equity market can keep going up. And gosh, the PE is high and like it's always mean reverted from here. So high PEs can be solved by the E exploding higher. So think about Nvidia. Nvidia stock in late 2019 had a PE of 58. It's grown 22 times in price since then, and the PE is lower. And so, I think people should stop. And like, by the way, we're trained to think linearly, as human beings. That's just the way we were programmed. Sometimes you have to think exponentially. And maybe what the equity market's telling you is if we're at $270 a share earnings for the S&P 500 this year, maybe the market's sniffing out that we're going to be at $900 in 2028. And maybe the forward PE is really low on the equity market. So I believe in patterns over time. I think you go through secular bull markets and secular bear markets. And if you can call up a chart of any one of those and not even tell me the date, they all look the same. Okay, so a secular bear market moves sideways over a long period of time with one or two very deep corrections in the middle. So think 1968 to 1982 or 2000 to 2013, where you ended where you started, but you had 250% corrections in both those. That's a secular bear market where you work off excessive valuation. Secular bull markets are born in pessimism, they grow in skepticism, they mature in optimism, they die in euphoria. I think this bull market started in 2013. I think it was pessimistic until the pandemic. I think it was skeptical from the pandemic until this year. I think the move from training to inferencing in AI is the onset of the optimistic phase. And the optimistic phase can be good for a double in the S&P from where it is. And then you have the euphoric phase. So think about 1995 to 1998 when the slope turned higher in the S&P and then it went vertical in the last 24 months. I think that's what's in front of us. So I think it's this, be aware of the notion of the failure of imagination. think exponentially, not linearly. I think we're staring at a set of influences today that when you combine them together, we've never seen before.
All right. With that optimism, I'm going to close with one last question. What is the story with the Grateful Dead poster?
I'm a dyed in the wool Grateful Dead fan. I saw the real thing before Jerry Garcia died over 70 times back in the day.
Jeez.
And I've seen, I can't even count how many different iterations of Dead cover bands and the like since then. Great American music.
Love it. I thought you were going to say that's where the safe with all the gold was, but okay.
It might be.
It might be, right. All right. Well, thanks a lot for your time today, Russ. I really appreciate it. And for the rest of you on this call, if there's anything we can do here at BGM, please reach out, and everyone have a great day.
Thanks, John. That was awesome.
Thanks a lot. Bye-bye.